For the last 30 years, the entire global financial system has been running on a kind of secret fuel source, an engine of cheap, practically free money, all coming from one country, Japan. Well, that engine is shutting down, and the consequences are starting to shake markets absolutely everywhere. In this explainer, we're going to break down this great unwind.
So, it all really boils down to this one massive question. What actually happens when a 30-year party fueled by free money finally comes to an end? And this isn't some academic exercise, some thought experiment. Nope, the global financial system is finding out the answer right now in real time. Okay, so first things first, to really get what's happening now, we have to understand how this whole machine worked in the first place. For decades, Japan was the world's undisputed provider of cheap capital,
And it all centered on this one beautiful strategy called the yen carry trade. The idea was incredibly simple and, for a very long time, ridiculously profitable. You see, investors could borrow Japanese yen for next to nothing. We're talking near zero interest rates. And then turn around and pour that money into higher yielding stuff all over the world. US bonds, tech stocks, heck, even crypto. It was a massive global arbitrage.
And this wasn't just some fad. It was a long-term, deliberate policy that got more and more extreme over time. It started way back in 1999 with zero interest rates. Then in 2001, they fired up the printing presses with quantitative easing. By 2016, they were doing something truly wild: yield curve control, literally forcing their 10-year bond yield to stay pinned at 0%. Just think about that. It created this perfect, stable, unbelievably cheap fire hose of money for the rest of the planet. So why on earth is this 30-year-old engine suddenly sputtering to a halt? Well, the answer lies right at the source, inside Japan itself. And this really shows you just how dramatic the shift is. For nearly 30 years, wages in Japan basically went nowhere, growing at a glacial pace of about 0.1% a year. It created this deep-seated deflationary mindset. But then, in 2025, boom, major companies agreed to hike wages by over 5%. That's the biggest jump in over 3 decades, and it's finally lighting a fire under inflation in Japan. And on top of that, you've got this policy tug-of-war happening in Tokyo. The Bank of Japan is slamming on the monetary brakes, hiking interest rates to get that new inflation under control. But at the exact same time, the government is hitting the fiscal gas pedal, pumping trillions of yen into the economy. This clash puts the central bank in a really tough spot, forcing them to tighten even faster to keep the yen from going into a nosedive. So, the free money engine is stopping. And the result? Something we're calling the Great Yen Repatriation. It's a massive wave of money that's now rushing back home to Japan. To give you a sense of the sheer scale here, just look at this number: $1.1 trillion. That is how much U.S. government debt Japan holds. They are the single biggest foreign owner of U.S. treasuries, and for decades, they were the buyer you could always count on. And this right here explains exactly why all that money is flowing home. It's just simple math. Imagine you're a giant Japanese pension fund. You look at a US 10-year treasury and see a pretty good yield, right? 4.2%. But to protect yourself from the yen swinging against the dollar, you have to pay to hedge it, and that cost eats up about 3.5%. So your actual take-home yield is a measly 0.7%. Meanwhile, you can just buy your own government's 10-year bond and get a clean 2% yield with absolutely zero currency risk. I mean, it's a no-brainer. And, it's not just about chasing a little extra profit. For Japan's enormous insurance and pension funds, this is about safety. It's about being able to match their long-term promises, what they owe their policyholders decades from now, with safe, reliable domestic bonds. Now, make no mistake, this is not just a Japanese story. What's happening is creating these powerful and sometimes violent ripple effects across every single asset class in the world. Let's look at a perfect real-world example from August 5th, 2024. The Bank of Japan announced a really tiny, modest rate hike. The market reaction was anything but modest. It triggered an immediate, dramatic unwind of all those yen carry trades. The Japanese stock market had its worst day since the crash of 1987. And that shockwave hit everything. Assets like Bitcoin got absolutely hammered, plunging nearly 20% in just one day. This new world is also totally changing how different assets behave. Gold is starting to be seen as a true safe haven, a hedge against worries about government debt and currencies losing their value. It's actually done well. Bitcoin, on the other hand, has acted more like a proxy for liquidity, for cheap money. When that ocean of cheap money starts to recede, Bitcoin suffered. Okay, so let's bring this all home.
what does all this global financial drama actually mean for you and for a typical investment portfolio?
Well, it's creating a very dangerous situation called a bear steepener. The problem is simple. Japan, a massive, price-insensitive buyer of long-term U.S. bonds, is walking away from the market. The result? Long-term U.S. bond yields have to go higher and higher to attract new buyers. And here's the real danger for a lot of people. This breaks the fundamental logic of a traditional 60-40 portfolio. You know, the idea that bonds protect you when stocks fall. In this new world, they can both fall at the exact same time.
What we're witnessing isn't just a temporary market shock. We need to be clear about this. This is the very beginning of a completely new financial era.
I think this quote from one of our sources just sums it up perfectly. For years, the yen carry trade felt like a cheat code for the global markets. Well, the infinite money glitch has been patched. So let's just quickly recap the key takeaways here. Japan's 30-year experiment with free money is officially over. That means the yen carry trade, a huge driver of global liquidity, is reversing. All that Japanese money is heading home, which is pushing U.S. bond yields higher. Volatility is the new normal, assets are playing new roles, and maybe most importantly, the world is having to relearn how to live with a positive cost of money.
And that leaves us with one final crucial question. For 3 decades, Japan basically subsidized the cost of money for the entire world. In this new era, who is going to be forced to pay the real price?